on our Twitter and Facebook pages. Watch me live in conversation with Ramdev Agarwal.
Ask me what you want to know from me. Only on BloombergQuint.
Summer 2073 has been a great year for market, and stage is all set for an equally good start of summer 2074. Now, the biggest question in everybody's mind is what stocks really to buy for new Samvat?
Well, clearly, and this time the stock picking has to be agnostic of what the market so far has been doing, Pradeep. On that note, let me introduce our guest for the show, who will be taking you through their top picks for till next Diwali. So joining us on the show is Mr. Lilladher of Prabhudas Lilladher. We've also got Sudhir Bandyopadhyay of Inditrade Capital and Hemang of Sharekhan. Thank you very much to all three of you for joining us today, and also wishing all three of you a very, very happy, prosperous and a very profitable Diwali, at least till the next Samvat of 2075. Let me first talk about the markets. As Pradeep was mentioning, 2073 has been quite profitable. I think Nifty has given returns of 17 to 18%. If I look at the stock market, it's all about economic growth. It's all about earnings growth. But we've not achieved anything here. Are we willing to ride that tide of only chasing prices here?
So let me begin by wishing all of you all a very happy Diwali and a prosperous new year, and to you as well as to all your viewers. I think yes, markets have been very kind, and markets have done pretty well. And most important, I think markets have been surging ahead in terms of the prices as compared to the valuation. So in that sense, it has been a very challenging times, because valuations are simply, prices are simply far ahead of the valuations. And we are just seeing that even the economy is yet to catch up in a way which will give a lot of confidence to the investors. And of course, the corporate earnings are still lagging way behind. You know, so you have these three equations. You have corporate earning prices very high, followed by economy, which is way behind, and then you have corporate earning, which is simply lagging much behind. So as we move into this year, I think we think that markets will continue to be very challenging in the sense that at this overvalued levels, to try and pick and make money is going to be a kind of a challenge. So I think till the time both these factors give some kind of tailwinds or some kind of comfort, markets possibly will in the short term will remain range bound. But there is no doubt that in the longer term we all feel that the trajectory is one of northwards, and markets should continue to do well, especially given the fact that there is a good amount of domestic liquidity which is swashing the markets.
Sudeep, you know, we normally believe in markets, and all of us are, you know, market participants. I have been tracking market for so many years, that earnings always follow the price. Markets probably know things in advance, but now when markets are, I mean, most of the stocks are quoting at record valuations. Do you see at this point that for coming 4 to 6 quarters, are there drivers that could, you know, push earnings substantially up to justify these valuations?
Well, Pradeep, I think so. I think there are enough and more opportunities for the earnings to move up. Remember, when we compare our corporates with what was happening in the valuations 4-5 years back, we must remember the fact that Indian corporates, by and large, have become very, very efficient in terms of controlling their cost, increasing their efficiencies, and that is across the spectrum. You know, you can pick each and every sector. I think all companies have done well in terms of increasing their efficiencies. Yes, there were some challenges in the domestic economy. We had you know, natural problems. The monsoon wasn't good earlier. We had some issues this year also with the monsoon. We had you know, demonetization. We had GST implementation. So I think there were some problems. But remember, at least the GST is a structural change, and that's going to help a large section of the companies going forward, particularly in the organized sector, which are pretty much listed and we deal with. Also remember, the global demand has come back to an extent. The economies in Europe, economy in US is doing well, and that creates good demand for Indian products and services. So I'm bullish on the future. Yes, we have been waiting very long for the earnings to pick up, and that hasn't happened. Yes, valuations have moved up quite ahead of the earnings. Economy hasn't moved as much as we would have all expected. But the fact remains, and I think the market strongly believes that the earning is going to move up. And if earnings are going to move up, I think there is going to be soon a scenario where the price at which the stocks are quoting now are justified. And probably it'll move up here on also. So if you can pick up good companies in good sectors which are going to give you growth, I think the sky is the limit even today. So we are probably seeing the beginning of a major bull run if things work out the way we are envisaging. And there are multiple sectors which probably will give you unprecedented return going forward. So I think we need to be careful as to what we are picking up. Also remember, the liquidity is more than enough. We have domestic liquidity, we have global liquidity. So I think it's kind of a combination, a lot of good factors. Some are yet to fall in place, some have already fallen in place.
Right. Pradeep, it's quite interesting what Sudeep highlighted. Last year, Diwali was on October 38, and then immediately we had demonetization. Indian markets have weathered all sort of storms, be it demon, there were some, fears of geopolitical tensions as well. Hemang,
if somebody bought there, he would be sitting on a, what, 40% return?
Yeah, from demon, I think 7,900 was the level in November, which one saw on a Nifty. But Hemang, let me take these questions to you. Markets have seen a lot of challenges, GST or demonetization, geopolitical factors. Going ahead, which are the biggest challenges that you feel markets will have to face? Because I can see the elections coming up now, and you've got probably the Fed could hike rates, and the whole interest rate cycle would change once again.
Yeah, I think what is important to note when you compare the bull market of 2003 to 2008 with what we are seeing right now, is that in the earlier period we had a broad-based earnings, led growth in the market, whereas here what we are saying is that only few sectors are doing well. Consumer-oriented, maybe a little bit oil and gas, metal, and auto to some extent. It's not a broad-based revival in the earnings. People are hoping that over the next 3 to 4 quarters, because of the reforms and because of the kind of liquidity that we are seeing, there might be a growth that come through. But there are a lot of other pockets, particularly in the broader market, where the rally is mainly driven by the liquidity, and there is a hope of earnings revival which may not come through, and there could be some kind of a disconnect. So what we are saying is that yes, we are in a bull market, but we have to be mindful of what growth expectations are we working with, and what kind of returns investors should have, given that last 2-3 years have been good. And we would definitely like to focus on the sectors and the companies where where the performance is there even in this particular time when there is a lot of disruption, rather than trying to hope that some sectors, some mid-cap companies will do well because of the good expectations that people have.
Since you always have had an eye for details, when you pick up a stock for next Samvat, will you rather try to avoid losses, avoid overvalued sectors, or there are options in plenty and you can choose, pick and choose very easily? So is it more of a selection or elimination? That's what I would like to know.
As I said that I would definitely like to go with the sectors and companies which have been doing well, because last 2 years in terms of economy, in terms of growth, have been challenging. We had a lot of disruptions. So the companies which have a better business model, better management quality, and where you see the growth visibility are the ones that I would go with.
And the top pick will be?
And my top pick would be IndusInd Bank, because this is one of the best performing banks in the last 2 or 3 years. It's been doing better than the Bank Nifty, and it's growing at about 25-27%. And we believe that this merger news which have come out with Bharat Finance, it's a large merger, and we think that there are certain distinct advantages that IndusInd Bank would have because of that cost of funds being lower, which would be a big advantage. Bharat Finance is a much better capital adequacy at 33%, so that will be one important thing. And the kind of priority sector portfolio that they have would also be a big advantage. There are going to be challenges because it's a big merger that they are working with in terms of integration, etc. But we think that now that the bank has been growing at 25-27%, if they do not do something to sustain this growth, it would be a big challenge.
Do you think without this merger consolidation, it would be difficult for a bank like IndusInd, who's been growing at that CAGR of 25% in the last 3 or 5 years?
Absolutely. I think for most of the private sector banks, it's absolutely important that they build, enough products around their core business to sustain this kind of a growth for the next 2 to 3 years.
So, but the only fear would be, we have seen the history of Bharat Financials, the kind of volatility we have seen. Won't this acquisition bring in similar volatility into IndusInd? Because when a news comes, you are not able to analyze it immediately, but the stock reacts, sentiments change. What kind of risk do you really see?
Absolutely. I think in terms of asset quality, we have seen that last 2 or 3 quarters, the asset quality issues have been there, particularly when you have major elections or when you have a drought period. They have been there, but we think that with much better management quality and the risk management systems that IndusInd Bank would have, they should be able to deal with it in a more appropriate way.
So what sort of returns till next Diwali do you expect on IndusInd?
We are looking at about 22% kind of a growth for IndusInd Bank from current levels.
All right, so Hemang is betting on IndusInd. That's his first pick. Let's go across to Pradeep. Your picks are from the small cap space, which is actually retailers' favorite. Let me start off with Advanced Enzyme, a company which has been giving margins of almost 40 to 45%, unheard of if you look at any other sector, so to say. And it's a chemical company which has also benefited because of some sort of shutdown in China owing to environmental norms. What's the rationale? What's the kind of target can one expect in the next 1 year on Advanced Enzyme?
Well, I completely agree with, I think you have mentioned a couple of very strong points of Advanced Enzymes. It's one of the largest manufacturers of enzymes in the world. They have an integrated facility. They're working on a lot of these natural enzymes from natural ingredients, which I think is the way forward. We strongly believe that's the way forward. They have a product pipeline which, as and when they launch and as and when they come to the market with, will have about $2 billion sales potential. So that's a very large market, which their annual $2 billion per year. So it's a very large market they're trying to address. Also remember that, because as you said, a lot of China and other places, there are some shutdowns, which is going to help Advanced Enzymes. Margins, as you mentioned, are fantastic. And we believe that structurally, India is positioned very well post the GST and other regulatory changes to support manufacturing. And what's happening? Basically, the manufacturing base of lots of these advanced economies are shifting to countries like India. And I think some of these chemical companies, Advanced Enzymes included, are going to reap the benefit of that. So we definitely have a cost advantage. We have the skilled manpower, and if we can put it to productive use, I think it's a win-win for everybody. So I think it's a great combination, and I think they have a long runway of growth going forward. So from current level, we see it giving about close to 30% return in a year's time.
So, ever since the company came into the market, we never had a comparable stock in India. So how really do you value it?
Well, I think, Pradeep, you have to look at the global peers, and you have to look at what's happening as far as their market share is concerned. See, these guys have a domestic market share of 30% plus. They did a small acquisition recently, which have taken their market share from about 25-26% to close to 33%. So they are doing the right things. They are growing the business. They are laying down the pipeline for future growth. I think these are the signs of a good management or a well-managed company, and we are extremely bullish on the entire story.
Correct me if I'm wrong here, Pradeep. I guess about 40 to 45% of the revenues also come from the top 10 clients.
Absolutely.
Is there a concentration risk here? Say if one client moves out or something, they may lose out on business?
Well, yes and no. I think, of course, there is concentration risk if you look at it that way. But I look at it positively because they're dealing with, large conglomerates. Right. And to a great extent, they are the back end for these guys. So as and when they have the need to increase their sales, and obviously Advanced Enzymes will benefit out of that. Having said that, they're also expanding into newer geographies, and because of the shutdown in other countries, they are getting a lot of opportunities to enter newer corporates to supply their products to them.
Okay, so 30% upside in Advanced Enzyme by next Diwali is what you said. Dilip, you'll start with a large cap or a mid cap?
I think I'll start with the large cap. Larsen Toubro looks pretty good and interesting. And I think where I'm coming from is that the way the economy is at the moment, government needs to do something to really kickstart. And I think infra is one which possibly will be given a lot of thrust. And because that is one sector which can bring about a good multiplier impact in the economy, especially in terms of jobs also. So we expect that in the residual whatever 1.5 2 years which is left, we are still going to see a lot of thrust on the infra, and that is where I think L&T looks very well positioned to capture the opportunities, possibly the only one of the few companies which has the balance sheet, and it has not done much over the last couple of years because the execution has been pretty slow despite the fact that the company had a very good order book position. Now we see that some of these things will change quite a bit, and we think that not just the order book which is going to give a confidence, it is also the rate of execution which is also going to give a lot of confidence, and which is what I expect is going to accelerate and pick up. And another thing what has been ailing the company has been the fact that the working capital was pretty stiff for them, because the working capital intensity of the business had really gone up. And what I think is that as we go forward, I think that cycle seems to be gradually easing as government releases more and more payments, so that the entire work gets it picks up and then it's properly executed. So against that background, I think Larsen & Toubro I feel is a stock which can still give about 20 the bottom line growth should be 20% plus for the next 3 to 4 years. And I think even the ROEs, which have been at a low single digit, should gradually climb right up to 18 to 19%. And with a new management also at the top, I think he has a good, impressive track record himself. So all these things makes me feel very confident that Larsen & Toubro from here on can give a return of 25 to 30% over the next 1 year.
Mr. Bhatt, then capex cycle has bottomed out, because that's been the talk when you talk about this sector like capital goods. And one reason why the capex was not picking up because of the credit growth, which I believe is a decade low. There's not been any revival there. So it's in a way connected, right?
So that's why I said my more emphasis has been on the infra side, because if you see Larsen & Toubro represents infra, it represents capital, it represents certain sections of even power segments. Sure. But I think it's the infra segment which still is a very large segment for Larsen & Toubro, and that is where I expect that the thrust which the government is giving and is likely to give more as we move on, I think that will be captured by Larsen & Toubro in their results.
Mm-hmm. Mr. Bhatt, 20 years back when I entered my business management class and we were given the preliminary introduction of top Indian corporates, the number one thing about L&T was it was a large professionally run company, and AM Naik has been kind of synonymous to L&T. Now with Naik gradually stepping out, will it have an impact on L&T? What do you really think? That's a big question for on the company's future.
I think it's a very valid question too, because we have seen that whenever such pivotal figures, when they step down, it has impact on the companies, and there are some transitional problems. In this case, as what I have understood is, they had been preparing the ground for him to step down and for the current management to take over. So I think in that sense, the current person at the top is also a very seasoned veteran who has been handling most of the businesses he has been overlooking for the last couple of years. So I think I do concede that yes, there could be some question marks, some apprehension on how this transition is going to happen. But my own take is that in spite and despite this new management will be able to take over and take this company forward in a very meaningful and in a very profitable way.
Mm-hmm. It's kind of a disparate conglomerate in some sense. There are some businesses which could be hived off. There are some businesses they've been planning to kind of list as separate company, and they have done with 2 technology companies as of now. Do you think there is further scope for such value unlocking, or maybe just generating enough capital and cash by selling out some of the businesses? Will it really happen?
Sure. I think there, of course, is a very big unlocking of values which can happen, and the cash receipt that the company can get. For example, even a simple switchgear division, if I'm correct, could be valued at more than $1.5 to $2 billion. And that itself would mean unlocking a lot of money and a lot of working capital which gets blocked out over there. So some of these things we have been hearing that how this company plans to take it forward is demerge some of the businesses and then possibly take it forward. But there is no such clarity at the moment which is available, though in our own analysis we do factor in that some of these things are likely to happen and which in turn will help build shareholders' value.
All right, then let's talk about the second picks of our guest. Hemang, let me come to you. You've chosen Aurobindo Pharma. When a lot of people are trying to stay away from the pharma space, they have not given any returns in the last 1 year. If I have to compare from Diwali to Diwali, Auro, I guess the stock has seen a good jump. It touched its all-time low levels in the month of May. From there about, we've seen good jump of 40%. Even at current levels, would you still bet at a time when majority of the market experts now are betting on domestic story?
Yeah, so our take is that a large part of the de-rating as far as pharma sector is concerned is behind us. Now we have to see what kind of growth expectations the market is working with. And if you take the case of Aurobindo Pharma, relative to the sector, the company has done exceptionally well. In terms of approvals, last year was one of the best for them. They've got the maximum approvals. And this year they are looking at launching about 25 odd products with some high margin products in the US market. And we expect the operating profit margin to remain in the range of about 16 to 18% for Aurobindo with the kind of focus that they have on certain product segments. Also importantly, the management is also looking at reducing the debt from about $560 million to about $470 million next year. And this is available at a PE of about 13 to 14 on an FY18 basis. So we think that on a risk to return basis, some of these companies where there is a growth visibility for next year with a decent operating profit margins are looking pretty attractive in a market which is otherwise looking quite richly valued. So we like Aurobindo for 1 year, and we are again looking at about 18% kind of an upside from current levels.
So, 2 to 3 years back, it was easy to kind of look at the pipeline of a pharma company and give your projection. How confident are you that there won't be, intermittent hindrances, there won't be a sudden inspection, a sudden notice, or any other kind of disruption? Because that's the biggest risk.
Yeah, absolutely. I think the US FDA, the way it has affected the performances of some of the large companies is going to be a key risk. But I think given the fact that some of the large companies are affected, the companies have started putting in place processes to see that it does not lead to any major issues. Secondly, in terms of price erosion, yes, because globally we are seeing intensity has increased. So there is going to be a price erosion, but at the same time, there is going to be a volume growth advantage for some of these companies which are relatively unaffected. So I think we have to combine both of these, and on a fair basis, the risk return looks quite promising for Aurobindo.
But do you see a possibility that the margins, the growth rates, and the valuation therefore can go back to where they were, say 3 years back?
That looks a bit difficult because unless you see the numbers come through, the market would not be in a hurry to give a much higher valuation. So we think that we'll have to wait for a couple of years. But at this point of time, because the sector was so bombed out, I think some of these companies could give you a good investment opportunity.
I think Aurobindo Pharma, in terms of its earnings multiple, it's available cheaper compared to the other peers of Sun Pharma. I think besides Glenmark Pharma, I guess, which is a bit little bit cheaper than Aurobindo.
Historically, it's been getting a valuation 40% less than some of the large companies. Right. After that, the company has actually started doing much better, but still it is quoting at a discount of about 30% odd. So we think that there's a scope for some kind of a catch up on the P multiple front also.
So what's the kind of upside you see?
We are looking at about 18% kind of an upside for Aurobindo.
All right, so that's Aurobindo Pharma. That's the second pick coming in from Hemang. Sudeep, you're betting on an apparel company at a time post GST. I think a lot of exporters have been worried with regard to this new unified tax regime. How do you think this apparel company will benefit? I think you've chosen SP Apparel.
That's right. I think you look at GST in a slightly longer time frame. If you're looking at GST within 2-3 months or quarters, then of course there is a lot of destabilization and uncertainty. But I think in a 1 year plus time horizon, and GST is going to be there forever. Sure. So I think these organized players will benefit. If you look at their domestic business, definitely they're going to benefit. If you look at their global business, which is growing and will continue to grow, I think they're going to benefit. There's absolutely no doubt in my mind. Look, they're in a very niche segment. It's not a run-of-the-mill apparel company. They are into children and infant wear, knitted garments. And there is this business is to a great extent, we have seen over the years, it's kind of recession-proof and proof of many things. A lot of destabilization happens, but you don't stop buying clothes for babies. You have to buy those, and population is growing, blah blah. So I think they're in a very, very niche, little nice business. The business is growing. They've completed their backward integration. It's a wholly integrated facility in a single area, and that gives them huge cost advantage. So I think the margins are going to expand for the company. Remember,
and what are the current margins?
Current margins is around 24-25%, okay. And it is going to expand from here on as well. Also remember, they're exclusive suppliers to a couple of global brands like Crocodile. That gives them a lot of strength. They've entered the US market recently with a couple of large brands. That will open up the US market for them. Balance sheet is good. Valuation wise, it's available at a reasonable valuation. And I think if somebody is betting for 1 year plus, I think it's a great buy. We are looking at 20% plus, definitely.
Do they have any debt on books?
Hardly. So I think a little bit of export credit and that, but nothing beyond that. So I think the scope for this company to take the business forward is significant. Today, it's not that well known, but I think that's the opportunity which the investor has.
So what kind of target you have?
We are looking at a target of 500 plus as far as this company is concerned.
By next Diwali?
That's right.
Okay. Mr. Bhatt, what's your next pick?
I think in the financial space, in the NBFC space, we have this Capital First, which has done pretty well in the last 1 year. But I think that's another company which still can go places, even from the current levels. Got a very impressive promoter like Warburg Pincus, and I think even the main person who's driving it has got a very good experience. But more important, I think, is they're in a very sweet spot. You have a lot of this space which has been completely vacated by the PSU banks. You have the frontline private sector banks which are catering to big tickets. They are in a spot where they can really cater to a growing market, and where they have been showing a growth of 40% plus in the last couple of years, and I think that should continue. 30, 35, 40% growth should continue for next couple of years. And more important, I think, is some of this consumer electronic space which has been completely dominated by Bajaj Finance, and where the kind of financing they do, the ROIs are pretty good in that. And I think this is a space where even Capital First has got very well entrenched right now, after laboring it out for last 2 years, last 2 to 3 years. So what I think is, this is a company where we will still continue to see 35-40% top line growth. We will still continue to see 35-40% bottom line growth. The real question that comes is, the ROEs still have to really catch up. They are around 12-13%, and I think that really has to catch up. And typically when you have the growths which is much ahead of the ROEs, the company will need financing and will have to dilute it very regularly. And I think the profitability will ensure that overall ROEs will catch up in next 2 to 3 years. We think that 16-17% ROE should be there by FY19, FY20. So I think this is a company where we feel that overall, on all the parameters, whether you talk ROA, whether you talk about ROEs, whether you talk about growth, they should continue to do well, and they're pretty focused on this particular business, and they're a good set of people.
I think it'll be better if we wrap the show on a positive note. So let's talk about all the stocks which they've said. There is somewhat of upside that our guests are expecting. On that note, we'd like to thank all our guests for coming here to our studio and giving their Diwali picks to our viewers. We'll wrap it up here. It's goodbye from Pradeep and my side, and wishing all our viewers a very, very happy and a prosperous Diwali. Happy Diwali.